Hi, I'm Kurt and I'm a value investor. And today I'm going to show you my analysis of Nexstar Media Group stock, ticker symbol NXST. I think this is a great company. I think the stock is trading well below its fair value. It's one of the best stocks that I've found. So without further ado, let's look at the financials of Nexstar Media Group and do a discounted cash flow analysis. Okay, so here I have my discounted cash flow analysis spreadsheet tool. This is fully built out, and right now I have the spreadsheet kind of empty of all the data of the company. That's why you can see these pillars are kind of all unchecked and nothing showing up. If I scroll through, we don't have any information filled in all of these tabs. What I'm going to do is I'm going to go through and plug all this information in, and you can watch me plug it in, and it's going to fill out this spreadsheet, and we are going to come back to this front page and get a fair value based on some desired returns and see what we should be paying for Nexstar Media Group. And the ticker symbol is NXST, and the market cap is 7.4 billion. Now, I was doing some research on this company before making this video, and I got to know the company even deeper level than I knew before. I read through almost entire annual report from last year, and I found out that, Nexstar Media has a lot more going for it than I first thought. I knew that Nexstar Media owned television stations. That is their business. They acquire television stations, and then they capitalize on the revenue from advertising on TV, airing TV. I knew they had some websites. I thought those were just the local news channel 8 website affiliated with the television station, and therefore I didn't think it was that large, but they have a larger online presence than I knew about, and they have some other things going on. So right off the bat, you may be familiar with The Hill, which is a online journalist political news outlet. Nexstar Media actually bought this company, I think last year, for I think it was $138 million. So they took $138 million, and I don't know how they financed it, if they bought it all cash or if they used debt. But they bought The Hill, which is an online website, online publication, I guess you could call it. They also own a 31% stake in Food Network. I was reading about the cash distributions that the Food Network pays them, and I think it's Discovery who owns the other 70% or so of the company. So it's a dual ownership between this company, Nexstar Media, and is it Discovery who owns the other part of Food Network. And Food Network just sends all of their profits, all of the money that's left over from their operations to those two companies. So Nexstar Media gets some cash from that. But of course, the core of their business is owning television stations, a business that is in an industry that's, you could say, slowing down. I mean, people are cutting the cord. Maybe they're not watching morning news as much anymore on television. Maybe they're switching to online sources. And I think that Nexstar Media, after doing some more research, is a very sound company that wants to put their money in the right spot to make good return. And so they're slowly moving to online. The online share of their revenues is still very low, but I think that they're going to continue to pursue that market, the social media, the online website revenue from site visits and all that stuff. So whether it's putting their news online, somehow figuring that out, I think that this is a company that has a great posture, a great position. So that's a little introduction to Nexstar Media Group. That's the industry they're in. So with that, let's just take a look and start to fill this out. So their PE ratio right now is under 9. There's 40 million shares outstanding, and yeah, look. So this is up to date. There's $7.4 billion market cap. Pretty big. You could say they're almost a large cap company. Okay, so let's look at their price history. This is the history of their stock. It's gone up quite a bit in just a few years. I mean, you're looking at this chart. Actually, let me zoom in. This chart goes back to 2005, and so really since about 2013, something must have happened, acquisitions, but the stock went way up, and since then they've been going up a lot with a sharp downturn, of course, during the pandemic when the world was ending, but sprung right back up and has continued past the previous all-time high quite a bit. And you can see this trend line. The dotted line is a beautiful looking line, and the R squared of this this daily chart against the trend line is 93%. So if you're looking for a stock that overall trends in a positive direction, trends and doesn't deviate extremely from the general average trend, this is a company that might match your, match your criteria. So let's look at the shares outstanding, and all I'm going to do is I'm going to paste in the data live so you can see. I'm pulling this from an external source, and what I do is I've built this spreadsheet out so that I can just paste data in and it's going to upload everything. All right, so I'm going to use the calculate button a lot because I set this to manual calculations, but here is the shares outstanding trend. You can see they issued a lot of shares right there, 2017, but since then they've been slowly selling them down and buying them back. Okay, let's fill in our PE ratio information. And if you guys want to know where I'm getting this financial information from, this is coming from Macro Trends. And so I'll put a link down in the description. Here's their P/E ratio trend. Okay, so maybe we need to delete a couple entries here just to get a better visual of what's going on. So I see 163. Okay, let's delete these guys, and let's even delete this 50 because those are just like extraneous situations where in a particular quarter their earnings were really low or something like that. Okay, so this is a better understanding of their P/E ratio trend, and this is going back to what, 2012. Okay, let's look since 2014. You can see that they spend a lot of their time north of a 10 P/E ratio. I mean, a lot actually between 10 and 25, I would say. So right now we're living just below 10. So I'd say we're on the low end. We're in the 5 to 10 band. And although they've dropped to that area recently, I think it's safe to say that it's below their normal P/E ratio. But it's definitely a trend that's not looking too good. I think what the market's saying is, hey, look, we don't believe in TV in the future, and so we're gonna have to discount you more in order to to pay for your future earnings, because your future earnings are not as certain. But I think I already commented on what I think about that. So here we're on return on investment. Let's put this in, and of course I'm gonna have to move this pink line. I want to set, it put it in pretty close. Okay, so yeah, perfect. The pink line shows the 10% mark. What I want the return on investment trailing 12 months, trailing 5 months, trailing 5 years actually, to be above 10. I like companies that can get return on investment above 10 consistently. Now this company is pretty close. I mean, they're living on the edge according to my rule. They're living between 10 and I think 15 a lot of the time. So not superb, not a lot above my criteria, but they did drop down below 10% return on investment a few times here in the recent past. But right now they're sitting above, and I don't see them, maybe this is sustainable above 10. We'll have to see, but I kind of like this, especially for the industry they're in. Now they do pay a dividend. Let me put their dividend in here. And I like companies that pay a certain amount of dividend. I don't like companies whose dividend is too high, and you can see the dividend history here. It almost looks like their dividend payout is slowing down a little bit, and here I have this trend line in. If I set the trend line, well, let's fill in 2022. So what I do is I just put in the quarterly information. So it's actually 37 in the last quarter, and in the year previous, it was 30. So let's see what 2022 is going to look like. Estimated dividend total is 125. So you can see I filled in 2022 here, and the trend line I put is sort of a 3-power polynomial trend line, just to show that it looks to me like they were ramping up dividends, and now they have like a negative bend on their dividend growth. But I was reading their annual report, and they said that their dividend growth since the time they started it, which I guess was in 2013, was compounding 25% per year. That's great dividend growth. So that's pretty good, although 101 to 118 is good, but 118 to 125, not so good. But just keep in mind that this is a company that does another thing I found from their annual report. This is a company that does really well in election years. And so their odd years, 2021, 2019, 2017, all those odd years, they're going to just tend to have less free cash flow. They're going to tend to have fewer profits. So take this a little bit with a grain of salt. All their results are sort of on a biannual cycle, I guess you could say. Okay, let's go to the golden free cash flow and see what we have on their free cash flow trend. There we go. And of course, this is all going to populate. And wow, look at that. That's a beautiful trend line. Yes, it has flattened out a little bit recently. And you can see the growth. I mean, this is the 3-year growth, the 5-year growth, the 10-year growth. Those are banging killer. This is amazing free cash flow growth. So what I do here is I plug in my assumptions for the future. And because this is television, the backbone of their business is television, selling television ads, and we all know that that's a declining business. I'm going to go ahead and set their horizon out and say 21 years plus out, which is, I guess, 2043 or whatever. They're going to be declining business at negative 2% per year in free cash flow. But before that, they're going to be declining negative 4% per year. I mean, I could set this to negative 4 too, but right now they're growing fast. And I think they're going to continue to grow fast. A lot of their growth may come from buying new stations, so it might be acquisition growth, but that's okay. I want to see that their underlying business is also growing, but I think, just keep in mind political ads. I mean, look at this year. This is a great time to buy the company. 2022 should be a strong year because it's a midterm year. Although there may not be as much spending on ads depending on how competitive the election cycle is and politics and all that stuff. So it's just a nice boost that they usually get in election years. But here I'm going to put in 22% because as a growth over the next 1 to 4 years, and this is going to scale down from 22% down to the value that I put for the 13 to 20 year horizon. So it's going to decline pretty fast. In the 5 to 8 years from now, it's only going to be growing 13%. 9 to 12 years, only 5%. So you see how this works. And I have a standard distribution based on the normal standard distribution that this has seen in the past. And that's what I set when I simulate the results. Tens of thousands of simulations on where this company's stock value should be. Okay, so that's free cash flow. I'm going to move to revenue, and you're going to see that their revenue's a little bit more stable than their free cash flow is growing really fast. Their revenue's not growing as fast, but I think that's a sign of a great business. They know how to improve their margins, and so let's take a look. Here's their revenue growth, and the assumption I put here is 18%, and yeah, I like that. You can see that in the recent quarters that it's been going a little bit more flat. Just like free cash flow, it's been flattening out. To me that's fine. I mean, it could bend up, it could flatten and go down a little bit. We don't really know, but the trend line is pretty good. And even if I flatten out this trend line a little bit more, of course I can make this trend line a little bit more logarithmic. I can make it linear. It's still a good uptrending, trend line on revenue. And so when I look at the 3-year growth, the 5-year growth, and the 10-year growth, I'd be most inclined to put in something closer to the 10-year growth. But let me just be on the conservative side and put 18% over the next 4 years and scale that down again to negative 4 and negative 2. Net income is the third angle we look at when we forecast their free cash flow. We can translate revenue to free cash flow, but we can also translate profit, net income to free cash flow, and paste it in wrong here. So let me recopy that. And again, I'll put the link. I copy all this data quarterly from Macro Trends, or however it comes on the spreadsheet. I just go to the Macro Trends page. So big shout out to them. That is where I get all my financial information, and they're a huge help when you just need to copy and paste in financial information. It's really tough on MarketWatch and Yahoo Finance. So I found Macro Trends to be really good. Now here is net income. The trend, I'm going to put in 24%, but you can see they're a lot more up and down on profit. But of course, there's lots of things that influence profit. So you've got write-downs and acquisitions and all sorts of things on the books. But look at the trend line. The trend line doesn't lie. You go long term, and this thing's a beast. And so I'm not going to expect 40% returns. I'm not going to expect 60% returns in the next 4 years, but I'm going to expect 24% returns because that's what this company has shown. And of course, we're going to scale that down again to -4% in the horizon and -2% perpetual. Now let's go to the balance sheet, and this is one of the key things that I look at. I mean, the balance sheet of a company tells me a lot about the company. So I'm going to go to the most recent quarter, so what their balance sheet stands as of right now. Of course, these financials are all from March 2022. When we get June data, that's going to go in here. But right now, for a lot of companies, we're working on somewhat old data. One quarter, we're getting the most recent quarter is March, so we're getting new quarter information pretty soon. Their cash on hand is $342 million. Total current assets is $1,482. Property, plant, and equipment is $1,502. Intangibles. Now, if you've watched my Tyson stock analysis video, you'll know that I do not like intangibles. Intangibles is like the brand power of a company. And of course, a company putting on their own balance sheet what their own brand is worth, how am I supposed to trust that? How am I supposed to know? Of course, there's accountants and there's auditing that goes on, so they can't put something totally ridiculous on here, but to me, it's so subjective. A company's brand could be tarnished overnight, but of course, their intangibles are made up by television stations, and it's tied to their affiliates like NBC and CBS and ABC. So those brands are really powerful. I mean, people are going to turn on their television and they're going to go to those television stations. So I'm going to give them a huge break here because intangibles makes up a lot of their power. I mean, of their assets, their total assets, because they own big brands like The Hill. That's a publication that people tune in because they know that brand. They know that URL, thehill.com. So I'm going to divide their intangibles in half. And I'm going, because what we're going to end up doing is subtracting their intangibles from their total assets. So I'm just doing a technicality here. But the real intangibles are 8.6 billion. That's what they claim. Their total assets then are just over 13 billion. Let's look at liabilities. Total current liabilities, 734. So right now I'm just looking at their cash and their current liabilities. That seems to balance. They've got half the cash they need to cover the debt that's coming due in the next year. Plus they have, of course, all those other current assets. I'm okay with that. I like that. Long-term liabilities, 9 billion, 9.4 billion. That's a lot of debt. So this is the one thing about this company that's giving me red flags. I'm overlooking it for all the other reasons, but this is you're going to see on the pillars page, the one thing they get hit with is their debt pillar is not good. Now here's some of the just quick ratios we look at. Equity to debt. So they have more equity than debt. Okay, kudos. That's even with well, actually, no, that's notwithstanding the intangibles that we're going to subtract. So if you subtract the intangibles, half the intangibles from their total assets, they actually have equity to debt ratio less than 1, just very close to 1. So that's okay. That's okay. Cash to current liabilities is half. That's not ideal. I'd like that to be closer to 1, but my criteria on my pillars page is 33%. Price to book value is 2.5, 2.5. That's kind of high, but it's whatever. This company is not based on their balance sheet. This company's value is going to be based on their future earning potential, which is coming from this huge growth in their free cash flow. So balance sheet is not the best. It's definitely not the best, but it's okay, mostly okay. A couple little red flags, but we'll overlook those for now. So then I go to my margins, just to translate my my revenue and net income into free cash flow using historic ratios. And for this, I just need to delete some of these outstanding things, like when they went up to 40 something, and I'm going to take out 13 something, and I'm going to do this on both net income and free cash flow. And let's go ahead and look at the chart. Here's the average. I mean, I could gray this out. This is something that comes up just for my guidance, and then this is the value that I enter in. So let's go ahead and say that, I mean, just looking at this, I want to put a number that's on the high side, but something that's accurate. So something that's very in the middle would be about 6 or 5. But just to be on the safe side, go a little bit higher than that on the ratio of revenue to free cash flow. So I'm going to say 7. And on net income, I'm going to say 1.2. I mean, you can see the net income chart here. They actually live a lot of their time below 1, but if you know accounting, free cash flow and net income should balance out pretty evenly. I always give the net income to free cash flow ratio a little buffer, usually 1.1, 1.2. Sometimes it gets a little bit higher, 1.345, but you should never be having a ratio that's close to 2 over the long term. So I'm going to give a 1.2 there for a cushion. I've already entered in my growth assumptions on free cash flow, revenue, and net income going into the future from now until eternity. But really going from now until 20 years from now, and then in eternity, we have like a decaying growth rate. So what does that mean? That means we can go back to our page here and just take a look at what happens. Let's click the calculate button, and this actually is already updated. So what we have here is the 3 different ways we're looking at it: free cash flow directly, looking at free cash flow as a function of revenue, and looking at free cash flow as a function of net income. And over on this side, we have our safety factor version. It's all of this just divided by this number here. Now for this company, I'm going to go ahead and put in a safety factor of 1.33. I'm going to divide everything, basically reduce it by 33% from the natural numbers, and just give that little margin of safety. And that's going to fold into the values on our front page. But just looking at this for another second, right off the bat, I'm looking in the region of, let's say 10% desired return. So look at the values here. We have, this is per share. These are the total market caps, and then in the column EGI and so on, we have the per share fair value for each return on investment, desired return on investment. So for 10% expected return, we've got 574, we've got 243, and 686. It's a pretty wide range. You can see that revenue sits a decent bit below the other two, and that's probably because this growth rate is lower, but I'm okay keeping that in there. It causes, it gives us a nice range. Over here we've got 459, 195. Okay, so those numbers, if I just want a 10% return, I should pay somewhere between, let's say, $200 and $250. Let's say $250, all the way up to about $550. That's the range I should pay. Now, that's a big range, but the question is, where is the price of the stock now? I want a 10% return. To get it, I need to buy the company at or below $250 to $550. Well, the current price of the company, if you remember, is $182 a share. So this is sitting comfortably below our fair intrinsic value for the company based on a discounted free cash flow, a sum of their discounted free cash flows. So here are the low, medium, high estimates. Of course, this is summarizing kind of what I just said. About 220, 500 is the medium, and high at 630. That's a wide range. That's including the safety factor and the non-safety factor. And so it's a little bit of a mix there. Now, if I want a 15% desired return, now the company's not looking so hot, but the low end of the spectrum is $123 per share. But the medium is $274. Remember, it's priced at $182. So even with the 15% return, the medium intrinsic value price is $274. It's well below that. And of course, I also have this high end probability of the distribution of $364 a share. So this company is very much undervalued. I think it's a decent bit undervalued. Or let's say $200 to $400 per share. That's fair. And right in the middle, there's about 300. So if I had to just throw out a number that just based on everything that's come into my head for 10 to 15% desired return, I'm going to say $300 per share. That's the closest I can give to the fair value of this company. Now, at $182 a share, is that a buy? Of course that's a buy. Let's take one more look at this company by virtue of their pillars. Now, the pillars just tell me how predictable, how stable the business is. They could have great valuation based on forecasting their future free cash flow, but if their pillars are bad, then their forecasted future free cash flow could be kind of hairy. It could be kind of off. It could be kind of, it's not a stable business. But a company that has lots of green check marks is a stable business. Now, it says 6 and 17, just automatic counting the check marks. But of course, I'm going to look right here. I'm going to say the 79% for total minus intangibles minus property, plant, equipment greater than the total liabilities. It's 20% under. It's supposed to be 100% or higher. That's close, but no cigar. Here, net income increased 4 of last 5 years. It's 3 of last 5. Okay, pretty close on that front. And yeah, this one's way off. So their debt definitely has a red X. So they're going to be a 7 pillar, but I'm going to go ahead and lean on the side of giving them the green check mark for this one, or half of a green check mark, to bring them to a full 7 out of 8. And that's going to equate to 17 or 18 out of 21. That's a really good score on pillars. What it means is that the dividend they're paying out is small enough to where they can use a lot of the free cash flow to reinvest in the company. Their return on invested capital is above 10%. Now, it's not a lot above 10%, but it's above 10%, so it meets the check mark. Their P/E ratio is low. Their market cap to free cash flow, their free cash flow ratio is low. It means that they're consistently growing free cash flow. It means that their cash flow has grown a lot over the last 5 years. It means that they're consistently growing revenue and net income, although on net income, they're a little bit wonky, but that's okay. Overall, great pillars. The debt is the only concerning thing about Nexstar Media. So this is a company that I personally own. I can overlook the debt. In fact, in an inflationary environment, the debt is a little bit less of an issue, but that's okay. I like companies that have less debt. So debt is actually usually a big issue for me, but I think they have what it takes to cover their debt. I mean, I think their free cash flow is growing so much that they're going to be able to manage their debt well, and I think their growth outlook is so good. And just reading through their annual report, I could just tell, you just read the executive summary from the CEO and just know he is shareholder focused. He's into growing the business and making it a sturdy investment for shareholders. It's not anything crazy. It's not anything wild. It's just a very well-run company. And of course, we're in an election year now, so maybe this is a time to buy, because over the next 3-6 months, they're going to get a lot of free cash flow, and it's going to be represented in their income statements, and maybe the market will, sniff it out. One of the great things I love about companies I find that aren't being talked about is that, there's not a lot of noise. This company's just kind of sitting out there. It's a 7.4 billion market cap, but you don't hear, Warren Buffett talking about it. You don't hear the meme stock people talking about it. You don't hear huge big names talking about Nexstar Media. They own television stations. So it has that obscurity that I kind of like. When you find something that's really good in a little niche market that you can kind of understand and wrap your mind around, you like the numbers, it's not being covered heavily. That means it's not artificially high. It means that it's artificially got a little bit less coverage, and so might be a good opportunity. So what do you think about Nexstar Media? Go ahead and comment down below, and if this video benefited you at all, please give it a like and subscribe if you want to see more discounted cash flow valuations like this one, and keep your YouTube feed full of great valuations of companies so that you can stay ahead in the market. With that, I'll see you next time. Take care.